I love CAVA. I love their food. I love how it makes me feel. It's reasonably priced. And I love buying stock in companies that I genuinely think are good companies, companies where I genuinely enjoy their product. But I got to confess, every time I look at CAVA stock, I just think the price is crazy. So we're going to look again at CAVA stock today. Last time I looked at CAVA stock, I think it was trading for about $120, then went up even more to like $150. Now we're down to 90. Maybe it will look a little bit more reasonable. Who knows? Let's get into it. I'm going to update my sheet so I have the most recent information. Basically, I'm scraping a whole bunch of data, revenue, operating income, all the stuff that I want to look at on a stock. I'm pulling that all into this sheet. Now, CAVA has only been a public company for several years, so we don't have as many years of information as we might have on other companies. But here we have it. You see, revenue has been growing, and this is a company that has only just recently turned profitable. Oh, so few years of data that this didn't work. Let's fix that. Bam. All right. This just helps so I can quickly visualize the data that we got. So for example, we can see operating income was negative and it's only recently turned positive here. We can also see all their margins are moving in the right direction. But because this company has only recently turned into profitability, might be a little bit harder to predict their future earnings than other companies, just because, where is this profitability going to end up? Where are these margins going to level off to? Really quickly, if you're not familiar with CAVA, this is what they serve. They serve these bowls. It's a kind of a Chipotle style thing where you build what you like, you choose the base. I personally like to mix the lentils with the super greens, and then you can add the protein and some hummus, some avocado, whatever veggies you like. Honestly, it's a really nice experience. If you haven't tried it, I love me some CAVA, in case I haven't made that clear. Now, looking at their most recent earnings, there's a lot of stuff to like here. Revenue is up 28% year over year. That's fantastic. They're now saying that they're free cash flow positive. $2.7 million of free cash flow is essentially nothing for a company like this, but hey, it's a positive number. That's a good thing. Same store growth of 11%. That's not bad. And the real growth is coming from them adding restaurants. And if people keep liking their restaurants, if there's more people like me out there who keep liking their food, and not only are they growing the restaurant count, but they're also growing same store sales, that's a great combination. They pretty much reaffirmed their guidance that they'd already had. They're saying same-store sales growth of 6 to 8%. So they think that same-store growth is going to slow down a little bit. They think they're going to open 60-some new CAVAs this year. And let's use this information to try to predict, okay, what do we think about the stock? Is this a decent investment going forward? So for my base case here, I made some assumptions. Now, these assumptions are not really what my base case per se is. It's not what I think is going to happen. It's just to illustrate the point that the stock is really expensive. So the assumptions I made are revenue growth is going to grow 25% every year for the next 5 years. Well, we just saw that that's pretty much what they're doing right now. They're doing 28% in this most recent quarter year over year for revenue growth. That's fantastic, but as companies grow, they're going to slow down that revenue growth. It's not easy to grow 25% on the top line every single year. Is it possible? Yes. Is this likely that CAVA is going to do this, grow 25% every single year for 5 years? I don't think so. So this is pretty optimistic. As far as operating margin, well, we see that they just recently turned positive. I'm assuming that their operating margins are going to get to roughly where Chipotle's operating margins are at now. So Chipotle's operating margins are in the mid-teens. Chipotle is a very well-run company. For CAVA to reach 15% operating margin in 5 years, I think might also be a little bit optimistic, but let's say that they get to Chipotle level. I can't really give them credit for any free cash flow for the next 5 years because any cash that they make, that's going to just go back into building new CAVAs. So any cash that comes in, it's not going to go to shareholders. We're not going to get that because they need to use that cash to fuel this growth that we're giving them. And as far as a multiple to pay for this company 5 years from now, just for comparison, Google trades for roughly a 19 times multiple. Microsoft trades for roughly a 35 times multiple. Apple trades for roughly a 32 times multiple. So these very high quality companies are trading for low 30s. I think giving CAVA a 25 times multiple is pretty generous, a little bit optimistic. So I think we have not skimped on our assumptions that we're making for CAVA going forward. And what does this mean for our money? Well, if all these assumptions come true, and if you invest in CAVA today at $90, then you would earn 1% every year for 5 years. That's it. I really want to like the stock, but I can't. I mean, frankly, last time I looked, when it was like 120-ish, this was even uglier. And let's look at how ugly it could get and maybe how good it could get as well. So if we put in our quote-unquote bearish assumptions here, I mean, I don't think it's that bearish. 15% revenue growth every year for 5 years, that's pretty good. Operating margin, I'm still giving them 15% operating margins, meaning that they're going to get to basically Chipotle level of operating efficiency. Still can't give them any credit for free cash flow, and I'm going to give them a 15 times multiple, which is that low? Yes, it is, but is it unrealistic? Is it crazy? I'm not sure that it's so insane. I mean, maybe we'll give them a 20 times multiple. If you give them a 20 times multiple, you're going to lose 11% of your money every single year for 5 years. I'm basically saying in this scenario, the fair value of this stock is like 30 something bucks and it's 90 today. It's 3 times overvalued if you believe this scenario right here. And as far as what we would need to put in numbers wise to make the price make sense today, okay, I'm going to have them grow 25% every year for 5 years. I'm going to give them operating margins that are better than Chipotle. So this would be insane operating efficiency here. I'm going to say that in a few years, actually, we're going to get some of that cash flow coming to us. They're not going to need to use all of it for opening their stores. And I'm going to give them a 30 times multiple. We're going to give them, Microsoft, Apple level multiple here almost. Then you're getting 12% annualized return on this stock. If these assumptions are true, then it's worth maybe about $100 today. Of course, pretty much every analyst that's analyzing this stock is giving them a price target of 100 something, 115, 112, 115, 145. Tell me where I'm wrong. If there's someone out there watching this who really loves CAVA stock, not CAVA the food, CAVA the stock, I mean, what am I missing? I want to like it, but I just can't. This is just my opinion. If you're still watching at this point, subscribe to the channel. Let me know what companies you want me to look at next. Leave a comment down below. And this is just my opinion, not financial advice. If any of you are invested in this company, I hope it works out well for you. It's just not for me.